In the gleaming towers of Madrid's financial district in 1993, one man stood at the pinnacle of Spanish banking like a modern-day Caesar. Mario Conde, the charismatic president of Banco Español de Crédito, better known as Banesto, had built a reputation as Spain's golden boy of finance. At just 35 years old, he commanded one of the nation's oldest and most prestigious banks, wielding influence that extended far beyond the marble halls of corporate headquarters. Conde wasn't just a banker, he was a media darling, a political power broker, and to many Spaniards, a symbol of their country's economic modernization as it prepared to join the European Union. His perfectly tailored suits, intellectual demeanor, and articulate speeches on economic policy made him a frequent guest on television programs and a sought-after speaker at international conferences. But beneath the polished exterior and the carefully crafted image of success, Mario Conde was orchestrating one of the most audacious financial frauds in European history. What appeared to be brilliant banking innovation was actually an elaborate shell game that would eventually threaten to topple not just Banesto, but the entire Spanish banking system. The story of Mario Conde and Banesto is a tale of unchecked ambition, regulatory failure, and the dangerous intersection of political influence and financial power that nearly brought a nation's economy to its knees. Mario Conde's rise to power at Banesto reads like a carefully plotted novel of corporate intrigue. Born into a middle-class family in Vigo, Galicia, Conde displayed exceptional intelligence from an early age, earning a law degree from the University of Santiago de Compostela before pursuing an MBA at the prestigious IESE Business School in Barcelona. His entry into banking came through Banesto's legal department in 1987, where his sharp analytical mind and natural charisma quickly caught the attention of senior management. Banesto itself was no ordinary financial institution. Founded in 1902, it had weathered 2 world wars, the Spanish Civil War, and decades of Franco's dictatorship to emerge as one of Spain's most respected banks. By the late 1980s, however, the bank was struggling with the challenges of modernization and increasing competition as Spain prepared for European integration. Conde positioned himself as the architect of Banesto's transformation, proposing aggressive expansion strategies and innovative financial products that promised to catapult the bank into the top tier of European financial institutions. His meteoric rise culminated in 1987 when, at the unprecedented age of just 29, he was appointed to Banesto's board of directors. Just 1 year later, in a move that shocked the conservative Spanish banking establishment, Conde was elected president of the bank, making him the youngest bank president in Spanish history. His appointment was seen as a bold statement about Spain's readiness to embrace a new generation of financial leaders who could navigate the complexities of international banking and European monetary integration. From his first day as president, Conde embarked on an ambitious program of expansion and diversification that fundamentally altered Banesto's business model. He established investment banking divisions, expanded into real estate development, and created a web of subsidiaries that stretched across multiple industries and countries. The strategy was marketed to shareholders and regulators as a sophisticated approach to modern banking that would reduce risk through diversification while maximizing returns through synergies between different business units. Conde's public statements during this period painted a picture of a visionary leader who understood the future of global finance better than his more conservative competitors. He spoke eloquently about the need for Spanish banks to compete on the international stage and positioned Banesto as the institution that would lead this transformation. The bank's annual reports during Conde's tenure were masterpieces of financial storytelling, filled with charts and graphs that showed consistent growth in assets, profits, and market share. Financial journalists and industry analysts praised Conde's innovative approach, and international banking publications featured Banesto as a case study in successful corporate transformation. The Spanish government, eager to demonstrate the sophistication of its financial sector as it negotiated entry into European monetary systems, held up Conde and Banesto as examples of Spain's economic maturity. Behind this carefully constructed narrative of success, however, Conde was building a house of cards that grew more unstable with each passing quarter. The foundation of Conde's deception lay in his masterful manipulation of accounting principles and regulatory loopholes that allowed him to hide massive losses while reporting consistent profits. At the heart of the scheme was a complex network of shell companies and offshore entities that Conde used to move bad loans and failing investments off Banesto's balance sheet. These entities, many of them incorporated in countries with strict bank secrecy laws, would purchase troubled assets from Banesto at inflated prices, temporarily improving the bank's financial ratios. The purchases were financed through loans from Banesto itself, creating a circular flow of money that existed primarily on paper but allowed Conde to report the transactions as legitimate sales. When auditors or regulators inquired about specific transactions, Conde's team would produce documentation showing arm's-length deals with independent buyers, conveniently omitting the fact that these buyers were controlled by Conde himself or his associates. The scheme was further complicated by a series of cross-investments between Banesto's various subsidiaries that created the illusion of profitable business relationships while actually serving to concentrate losses in entities that were kept hidden from public scrutiny. Conde also exploited differences in accounting standards between Spain and other countries to book the same assets multiple times across different jurisdictions, inflating Banesto's apparent size and profitability. The manipulation extended to currency transactions, where Conde used the volatility of exchange rates and the complexity of international settlements to hide trading losses that should have been immediately recognized. Perhaps most audaciously, Conde created fake loan documentation for transactions that never occurred, allowing him to report interest income on money that had never actually been lent. As Banesto's reported profits soared and Conde's reputation grew, he leveraged his position to build a vast personal empire that extended far beyond banking. Using his access to Banesto's resources and his relationships with wealthy clients, Conde assembled a collection of media properties, real estate holdings, and industrial investments that made him one of Spain's most powerful business figures. He purchased newspapers and television stations, ostensibly as investments for Banesto, but primarily to shape public opinion and protect himself from investigative journalism that might expose his fraudulent activities. His real estate portfolio included luxury properties in Madrid, Barcelona, and the Balearic Islands, as well as commercial developments in major European cities. Conde's lifestyle became increasingly lavish, with private jets, luxury yachts, and exclusive social events that reinforced his image as a successful international businessman. He cultivated relationships with politicians across the political spectrum, making strategic donations to political parties and offering lucrative consulting contracts to former government officials. These relationships provided Conde with advance warning of regulatory changes and helped him influence policy decisions that affected the banking sector. His political connections also gave him access to inside information about government contracts and privatization opportunities that he exploited for personal gain. The line between Conde's personal interests and Banesto's corporate strategy became increasingly blurred as he used the bank's resources to finance his expanding empire while hiding the true cost of these investments from shareholders and regulators. By 1992, the contradictions in Banesto's financial statements were becoming increasingly difficult to reconcile, even with Conde's sophisticated accounting manipulations. The bank's rapid expansion had outpaced its ability to generate real profits, and the hidden losses were growing faster than Conde could find ways to disguise them. International auditors were asking more probing questions about Banesto's overseas operations, and European banking regulators were implementing new oversight requirements that made it harder to hide assets and liabilities across multiple jurisdictions. Conde responded to these pressures by escalating his fraudulent activities, creating ever more complex schemes to maintain the appearance of profitability. He began using Banesto's trading operations to engage in high-risk speculation in currency and commodity markets, hoping to generate quick profits that could cover the mounting losses. When these trades went against him, as they inevitably did, Conde simply hid the losses in the same network of shell companies he had been using for years. The circular loans between Banesto and its controlled entities grew larger and more frequent, creating a situation where the bank was essentially lending money to itself and calling it revenue. Internal auditors who questioned suspicious transactions were transferred to other departments or pushed out of the bank entirely, while Conde surrounded himself with loyal associates who were either complicit in the fraud or too intimidated to speak out. The Spanish banking authorities, still basking in the reflected glory of Banesto's apparent success, showed little inclination to conduct the kind of thorough investigation that might have revealed the true state of the bank's finances. The beginning of the end for Mario Conde came in late 1993, when a routine examination by Bank of Spain inspectors uncovered discrepancies that could not be explained by accounting errors or regulatory misunderstandings. What started as a standard compliance review quickly escalated into a comprehensive audit as inspectors discovered loans to non-existent companies, investments in assets that had been sold years earlier, and financial statements that bore no relationship to the bank's actual operations. The Bank of Spain's investigation revealed that Banesto's true financial position was catastrophic, with losses that exceeded the bank's capital by a margin that threatened its immediate survival. When confronted with the evidence, Conde initially attempted to discredit the investigators, using his media properties to launch attacks on the Bank of Spain's competence and motivations. He claimed that the investigation was politically motivated, designed to destroy a successful Spanish company that posed a threat to foreign competitors. Behind the scenes, however, Conde was frantically attempting to cover his tracks, moving money between accounts and destroying documents that might reveal the full extent of his fraudulent activities. The Spanish government found itself facing a crisis that extended far beyond a single bank, as Banesto's collapse threatened to trigger a broader financial panic that could destabilize the entire banking system. International financial markets were already showing signs of nervousness about Spanish banks, and the government feared that a disorderly collapse of Banesto could derail Spain's plans for European monetary integration. The Bank of Spain made the unprecedented decision to remove Conde from his position and place Banesto under direct government control, a move that sent shockwaves through the Spanish business community and marked the beginning of one of the largest financial investigations in European history. The full scope of the Banesto scandal only became clear as investigators peeled back layers of fraudulent transactions and hidden losses that had accumulated over nearly 6 years of systematic deception. The final tally showed that Conde's activities had created losses of approximately 605 billion pesetas, equivalent to roughly $4.5 billion at contemporary exchange rates, making it one of the largest banking frauds in world history at that time. The investigation revealed that Banesto had been technically insolvent for at least 3 years while continuing to report profits and pay dividends to unsuspecting shareholders. The network of shell companies and offshore entities that Conde had created to hide losses stretched across dozens of countries and involved hundreds of fictitious transactions designed to manipulate financial statements. Investigators discovered that Conde had personally benefited to the tune of hundreds of millions of pesetas through fraudulent loans, inflated consulting fees, and the use of bank resources for personal investments. The scandal's impact extended far beyond Banesto itself, as the bank's collapse triggered a broader examination of Spanish banking practices and revealed weaknesses in the country's financial regulatory system. Several other financial institutions that had dealings with Banesto faced scrutiny over their role in facilitating suspicious transactions, and the entire Spanish banking sector saw its international reputation severely damaged. The Spanish government was forced to implement emergency measures to restore confidence in the banking system, including enhanced deposit insurance and stricter oversight requirements that fundamentally changed how banks operated in Spain. The cost of cleaning up the Banesto mess ultimately fell to Spanish taxpayers, who funded the bank's restructuring through government bailout funds that took years to recover. The legal reckoning for Mario Conde and his associates proved to be almost as complex and protracted as the financial fraud itself, involving multiple jurisdictions and dozens of criminal charges that took nearly a decade to fully resolve. Spanish prosecutors charged Conde with fraud, embezzlement, falsification of documents, and criminal mismanagement, allegations that carried potential prison sentences of up to 20 years. The trial became a media circus, with Conde using his considerable charm and legal expertise to portray himself as a scapegoat for broader problems in the Spanish financial system. He argued that his actions were consistent with accepted banking practices of the time and that he had been unfairly singled out for prosecution because of his high profile and political connections. International authorities launched parallel investigations into Conde's offshore activities, freezing assets in multiple countries and pursuing extradition requests for associates who had fled Spain. The complexity of the financial transactions made prosecution extremely difficult, as investigators struggled to trace money flows through the labyrinthine network of companies that Conde had created. Many of the key documents had been destroyed or were located in jurisdictions that refused to cooperate with Spanish authorities, forcing prosecutors to build their case on circumstantial evidence and the testimony of former Banesto employees. In 2002, nearly 9 years after his removal from Banesto, Conde was finally convicted on multiple charges and sentenced to 20 years in prison, though he would serve only a fraction of that time due to appeals and sentence reductions. The broader investigation led to convictions of more than 30 other individuals associated with the fraud, including accountants, lawyers, and business associates who had helped facilitate Conde's schemes. The legal proceedings established important precedents for prosecuting complex financial crimes and led to significant reforms in Spanish banking law and regulatory oversight. The Banesto scandal left an indelible mark on Spanish banking and served as a cautionary tale about the dangers of inadequate oversight and the concentration of power in charismatic but unscrupulous leaders. The immediate aftermath saw a complete restructuring of Banesto under government control, with new management, enhanced oversight, and a mandate to restore the bank to financial health through legitimate business practices. The bank eventually returned to profitability and was sold to Banco Santander in 1994, though the purchase price reflected the massive losses that had been uncovered and the damaged reputation of the Banesto brand. The scandal prompted comprehensive reforms of Spanish banking regulation, including stricter capital requirements, enhanced audit procedures, and limits on the types of investments banks could make outside their core business areas. Spanish regulators also implemented new requirements for disclosure of related party transactions and created mechanisms for earlier intervention when banks showed signs of financial distress. The Banesto case became a standard reference point for banking regulators around the world, demonstrating how sophisticated accounting fraud could be used to hide massive losses and the importance of maintaining independence between auditors and bank management. For the Spanish public, the scandal represented a betrayal of trust that took years to overcome, contributing to broader skepticism about financial institutions and their claims of success. The ultimate irony of the Banesto story is that Mario Conde's stated goal of modernizing Spanish banking and preparing it for international competition was actually achieved, but only after his fraudulent activities nearly destroyed the very institution he claimed to be transforming. Today, Spain's banking system is among the most regulated and closely monitored in Europe, a direct result of the lessons learned from one man's audacious attempt to build a financial empire on a foundation of lies and manipulation.